The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A third week in the political pinball machine pushes some investors to tilt. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking off to closing bell here in the U.S. and quite a challenging tape we're looking at. The S&P 500 now down 1.5%. Looks like we're going to close out a fourth straight week of losses for your big index. You can see volatility rising in the equity market as measured by the VIX, now trading with the 27 handle, getting closer and closer to 28. Certainly not helped by what you're seeing unfold in the bond market. That's actually where the bulk of the day's action is. The 10-year Treasury yield higher by nearly 14 basis points. We're now looking at 440 on your benchmark 10-year yield, and oil continuing to climb here. Brent higher by about 4%, trading at 112, nearly 113.
Yeah, up about 50% since the war began, and that is eye-popping to be sure. But Bloomberg oil analyst Javier Blas, he actually says there are even more revealing indicators of the unfolding energy crisis. Heating oil in New York, that's up 70%. Gulf Coast jet fuel, that's up more than 80%. And the differential between a physical barrel of crude versus a futures contract now widening to new extremes. So with no reprieve yet from the U.S. military and no help yet from the U.S. Fed, investors now calculating those second-order effects of what's now the most severe supply-side shock to the economy in years.
So it temporarily will raise inflation. Temporarily, you take a hit to real growth, real income. And what do you do if you're a central bank, the Federal Reserve? Well, higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
And bond investors seem to have already sniffed this out, selling off treasuries across the curve, which is shifting yields from the short end to the long end higher. Even the stable world of muni bonds, that's turning volatile. Municipal bond funds Thursday posting their first aggregate daily outflows of the year, and the AAA muni yield curve now about to do something it hasn't done since 2024, and that's rise for 3 straight weeks. As for stocks, the optimism at the start of the week that even amid the war, the S&P wasn't far off its record high. Well, the index drifting further out to sea, a drawdown now approaching 7%, and what in less than an hour is likely to be its most significant close below the 200-day moving average, Katie, in almost a year.
And that alone tells you where sentiment in this market is right now. But let's take a look at another measure. Right now, you're looking at the AAII bull-bear spread in here at the bottom. It's now at the lowest, that spread, since the tariff fallout. You can see it's at about 21 right now. You zoom back, that is the lowest level since about May or so. Again, the price action already tells you this, but taking a look at this measure, you can see there's potentially further to go here, because back in February through May of last year, we were regularly visiting about 40 on this spread, negative 40. And again, we're only at about negative 21 right now, Romaine. So we'll see how this tape develops. But of course, it looks like there's no let up in the tension overseas right now. Yeah, with oil at session highs and right now stocks near session lows. Greg Boutle joins us right now, U.S. head of equity and derivative strategy at BNP Paribas. And Greg, we should point out every major index in the U.S. now testing that 200-day moving average. The S&P for the first time since April now in oversold conditions below that 30 RSI. I am curious if this is finally maybe that washout that everybody was looking for, and whether that creates an opening going forward?
It certainly feels like the positioning indicators that we look at, we would now say are in capitulation territory. So it's moved from this very shallow sell-off to one which is a bit more meaningful. And we think that certainly reflects investors that are lightly positioned and well hedged.
Well, it gets to the question, though, and nobody obviously knows where this war is going, but when you try to assess the impact of elevated energy prices for a longer period of time, and what the feed through is, not only to the economy, but for investors, more importantly, what's the feed through to corporate earnings? Because we've had several guests who said, look, wake me when, this starts to affect Microsoft earnings or NVIDIA's earnings. And at least for right now, we're not there.
Yeah, I think that's really the story. And the theme that we've been talking about for U.S. equities is this idea of relative resilience. It's not the idea that those things don't matter. It's that when we compare something like the U.S. equity market to the European equity market is just much more sensitive. So when we think about those big secular drivers of the mega cap stocks, we think they are much less vulnerable to what's going on geopolitically than maybe some of the more cyclical parts of the market.
Relative resilience. Let's talk about where you're relatively more worried right now, because I'm taking a look at your notes. You highlight consumer, not just discretionary, but staples as well. Talk us through some of your, headline concerns when it comes to these sectors.
Yeah, so really it's thinking about that transmission mechanism. As I say, if the broader US economy is, or US market rather, is more of a secular story, I think the impact to the consumer of higher energy prices, higher gas, is much more direct. Now, when we think about staples, that's typically a more defensive part of the market than consumer discretionary. But when you look at some of the relative moves we had coming into this crisis, staples had a massive rally at the start of the year. It was one of the best performing sectors. So we put a note out at the weekend saying we thought that consumer staples could be one of the best sectors to hedge. It's been the worst performing sector this week, but it's still the third best performing sector year to date.
It's interesting. I mean, when you think about staples, it sort of fits into a broader picture that sort of has me scratching my head, because you think about the typical defensive places of the market, not just in equities, but you think about what's happening with gold, what's happening with treasuries. It feels like, the places that the textbooks would say, this is where you go for safety. That math doesn't quite work right now, or not in the way you might expect it to.
Yeah, I think some of that is flows and positioning. So I mentioned staples had performed really well coming into this. Gold has been on a massive run over the recent history. So it starts to trade a little bit more like a speculative asset and less like a defensive one. The other thing that in terms of the transmission mechanism of geopolitics to the US economy, you could argue that maybe it's more important for inflation than it is for growth. Inflation is therefore going to affect the bond market. We've seen some massive moves in rates, and that's where it affects the defensives. The defensives as sectors are effectively bond proxies. So that's one of the reasons why they've come under pressure.
I mean, this week we heard from the two most significant central banks in the world, the U.S. Fed and, of course, the ECB. The ECB, at least if you believe what the betting markets are saying right now, expects rate hikes. The jury's a little bit out on the Fed, but no one right now is pricing in any chance of a rate cut in 2026. What does that mean for equities?
Well, it's quite a change from the narrative we heard at the back end of last year.
And the front end of last month.
Exactly. It seems like a long time ago, though. Now, I think it bleeds a little bit into this story again of relative resilience. So potentially the risks of a hawkish reaction function are worse in Europe than they are relative to the US. And then we think separately about the market reaction function. Again, coming back to those large cap US corporates, the mega caps, how sensitive are they to rates? Do you need to see front end rates lower for the mega caps to perform? I don't think so. I think hikes would be pretty unhelpful, but we think the Fed is going to be on hold for the balance of the year. And that is an environment where I still think the mega caps can perform.
What about for the small caps, my little guys over here? Because you take a look, year to date, the Russell 2000 is actually still outperforming the S&P 500. Then you take a look at the prior month, it's a totally different story. Small caps just getting thrown out the window here. I have to imagine this is one of the areas of the market where you really would like to see those rate cuts. Yeah,
exactly. It's a classic reaction function to what's being priced in from the Fed. Small and mid caps, the Russell 2000, IWM, it's always been very, very sensitive to CPI prints, what's priced for FOMC. So I think if we don't have rate cuts, that's clearly going to be a part of the market, which again, on a relative basis, is going to have a trickier time.
Greg, great to have you here. Greg Boutle is U.S. Head of Equity and Derivative Strategy over at BNP Paribas, kicking us off to the close here on this Friday afternoon. We should point out on Monday, Brent crude was actually around $100 a barrel. As we speak right now, it's right around 112. Our next guest has mapped out a variety of scenarios as to where it may go next. That conversation coming up after the break, right here on The Close on Bloomberg.
Another wild week for oil and gas prices, capping off with Brent crude and gas higher, WTI crude lower, and the Iran war showing no sign of letting up. Goldman Sachs research warning that Brent is likely to exceed its 2008 all-time high if depressed flows keep the market focused on the risk of lengthier disruptions. Joining us live is the analyst behind that call. His name is Daan Struyven, co-head of Global Commodities Research and head of oil research over at Goldman Sachs. Daan, great to have you with us. So in your most recent note, you map out the short-term view and the long-term view. Let's start with your short-term view that I read that Brent reaching record highs, not out of the question here. How close is that to being your base case?
Yeah, so it is very plausible just because this is by far the largest oil supply shock in the history of oil markets. We estimate that exports of oil from the Persian Gulf today are down 17 million barrels per day. That's 17 times bigger than the peak hit to Russian production in 2022. How fast we may get to the all-time high. It depends on two things. One, the length of the disruption. So I think every day that passes without an improvement in the Strait of Hormuz flows, or without signs that we're on the de-escalatory path, I think would likely continue to put upward pressure on prices. And second, it's also about the risk premium, right? The more likely the market thinks that you were to see either a very lengthy disruption or persistent damage to oil production potential, for instance, because of damage to infrastructure, I think the more the risk premium will rise. And so, yeah, those are the two things to watch. Watch the flows and look for signs that may inform you about the probability of that risk scenario, and especially the risk of damage to infrastructure.
Well, let's talk about some of the different spreads, too, that we're keeping an eye on. As I mentioned, Brent versus WTI, certainly a price gap that investors have been paying close attention to. We were having this conversation yesterday. When you think about, again, that divergence that has been developing, do you think that is short-term or perhaps turning into something more structural in nature?
Yeah, so we think the gap is now well above sort of the normal roughly $5 per barrel value. I think it reflects two factors. One, high freight rates, which are somewhat sticky, somewhat structural. And second, the market pricing in some probability of a U.S. crude export restrictions policy. If U.S. crude exports were restricted, you would end up with more oil supply in the U.S., less oil supply outside of the U.S., and so that would cheapen U.S. crude oil, the WTI benchmark, relative to international benchmarks such as the Brent benchmark.
How are you factoring at all, Daan, right now, some of the refined products and whether those remain elevated, or is there potentially maybe some moderation given how far out in front some of those prices have been relative to crude?
Yeah, so this is a bigger shock for fuel prices than for crude prices, especially for the prices of the so-called heavier refined oil products such as diesel, jet fuel, fuel oil. Two key reasons. One, the Middle East is not only a significant exporter of the heavy refined products, but also the Middle East tends to produce medium to heavier crude, which is the key input to make refined products that are heavier, including in Asia. And second, outside of Europe, most of the strategic petroleum reserves we're seeing are in the crude space as opposed to the refined product space. So the shock is bigger for products than for crude, and the policy response is not as powerful for refined products as for crude. And ultimately, what matters for consumer prices, real income, inflation, growth, is fuel prices. The only companies that pay crude prices are refiners. All the other companies and households ultimately pay fuel prices.
Are you seeing any evidence here of folks trying to stockpile? And I don't mean just here in the U.S., but globally. And if so, I mean, how much spare capacity, storage capacity is there for that?
So we are definitely seeing an increase in government stockpiling. Export restrictions have been implemented by China, Thailand, and a few other countries. And so as a result, by restricting product exports, in a way, you're exacerbating, you're amplifying the tightness in the rest of the world. In terms of government stockpiling, in the short term, we expect large SPR releases across the world. But I think one channel through which this shock may imply high prices for longer, the title of yesterday's report, is an increased pace of strategic stockpiling once the shock is over, both because the level of SPR reserves will be quite low once the shock is over. And second, I think we're all learning that the risks to energy supply are high, and policymakers may want to raise their target SPR levels.
All right, Daan, I really appreciate it. A very sobering look. And that, of course, that note that you just referenced, I really encourage everyone to go out there and read it here. A variety of risk scenarios going forward as we keep an eye right now on Brent crude here, post-settlement now at session highs. Daan Struyven, co-head of Global Commodities Research and head of oil research over at Goldman Sachs. When we come back after the break, we're going to pivot and talk a little bit about the wealth management business. JPMorgan has been building it out at a record pace here. And now another leg in that build out out, a program by athletes for athletes. Tom Brady, Sue Bird, just among some of the folks helping in that effort. We're going to talk to the CEO of JPMorgan Wealth Management, Kristin Lemkau, when we come back after the break. This is Bloomberg. All right, what do Tom Brady, Dwayne Wade, Sue Bird, and Megan Rapinoe all have in common? Not only are they some of the greatest athletes in the world, but now they're also part of the JPMorgan Chase Athlete Council. It's a new initiative that seeks to help athletes navigate every aspect of their sometimes complicated financial lives from their early career through retirement. This is the brainchild of our next guest, Kristin Lemkau. She is the CEO of JPMorgan Wealth Management. Great to have you here.
Great, thank you for having me.
Look, we've talked a lot on this show about how complicated it is from a financial perspective to be an athlete. You have a lot of people at a very young age being given millions of dollars with no real direction of how to spend it. And then, of course, as they navigate their careers and try to find ways to invest it, a lot of pitfalls along the way. Give me a sense here. I mean, I understand you're a wealth manager, but why specifically did you sort of look to these athletes and say, we can maybe actually make a business out of this and actually bring them on board to help guide it?
Yes, I love sports. I've loved sports my whole life. I think most of us have sports as part of the most favorite memories that we've had and some of the most proud moments for our country. And if you look at the statistics, they're staggering. Only 7% of high school athletes will go on to college. Only 2% of college athletes will turn pro. So we're all captivated by March Madness now with some incredible athletes. Most of them will not go pro. And then when you become a professional, so you're part of the less than 1%, your average career is about 4 years. So you're 28, you often didn't finish college because you were pursuing your career, and the peak of your earning power has just ended. So we believe there is wide open space here for my firm and my industry to be able to help some of these kids earlier on.
Well, what type of advice are you getting from some of the names that we just read off there with regards to what those athletes are looking for when it comes to managing their money, other than just, obviously protecting their wealth?
They were highly engaged. The one thing about athletes, they know how to work, and they were there to work. They had all pre-read the materials. We put things in front of them. They liked the framework of how we're looking at it, which is college, in many cases high school, professional, and retirement, but they didn't like the materials. They sort of threw up all over the checklist and the bank speak. And so they gave us some really interesting ideas on how to think about community, content, and connection.
So how are you, making contact with these athletes, college athletes, younger athletes in some situations? Is this those athletes coming to JPMorgan? Are you visiting schools? How do you sort of build that pipeline?
That was one of the things that we sought their advice on. But yes, the idea is we'll take Jalen Brunson to Villanova and Dwayne Wade to Marquette and have them talk about their stories. And then they gave us great advice on how to think about, just give them really clear options of how much they can spend, how much they can save. So we're in the process of I sent them all a list of follow-ups last night and what we're asking their feedback on, and we're going to build the programming around the advice. That was the intent. We needed to hear from them before we could do it.
And I'm really curious, how does this benefit JPMorgan? How is this a business for you? Is the idea here that they're using JPMorgan products, JPMorgan services? How does this come back to the bank?
Yes, we're not paying them to sell credit cards or checking accounts. We are paying them for their advice on how to reach these athletes. And they've given us super constructive advice. We believe we will get business from it, but that wasn't the original intent. We're one of the largest corporate sponsors of sports in the world. We have Madison Square Garden, the US Open, the Chase Center, the Warriors, and therefore we have access to a lot of these athletes. And we'd heard over and over again that there's a big problem and there's unoccupied space.
And beyond just athletes, I'm actually very fascinated by what you've done over the last 5-6 years since you took over the wealth management business there. It has grown rapidly.
Thank you.
And that seems to be by design. I mean, Jamie Dimon clearly put a big focus on that when the way he reorganized that back in 2019, 2020. I am curious about the growth that we've seen from 500 million in assets to whatever it is, well over
1.3 trillion.
Trillion.
You for asking.
Sorry. You got the 1.3 trillion. But it gets to this idea of wealth management now effectively becoming the dominant business for a lot of the big banks. And I am curious, is that just a generational thing, a structural thing that we're going through, or is something else driving it?
Well, I think when interest rates went up, people realized that having your money sitting in cash was not that fruitful. And then during COVID, a lot of people got into self-directed investing on their own and ways to pass the time. And I think people are just getting smarter and the tools are getting better. One thing about my business is at 1.3 trillion, we're still a small business at JPMorgan, but we can serve anyone. Whether you have $5 or $5 billion, we can serve anybody. And that is the intent and the hope. And frankly, through the athletes, we hope to get to more of those underinvested groups like women, communities of color who haven't been investing at the same rate as other people because they look up to these guys and want to listen to them.
Well, to that point, I mean, you think about the markets, what we've seen in terms of the headlines over the past month or so, that underinvested community, some of the news flow, what have the conversations sounded like? Are people being scared away from these markets?
We try to get people focused on the goal, which is, okay, your goal is to retire by here at this age with this lifestyle. Are you still on track for your goal, yes or no? Or do we need to make some adjustments to your portfolio? But we can't let people wig out if the market's up or down because most people, including us who try to time it, will get it wrong. We instead try to keep them very focused on the goal and whether they need to make some adjustments along the way.
So it's obviously a long-term focus, but the short-term still matters, right?
The short-term still matters, particularly if one goal is retirement and the other is I've got a 16-year-old and I need to save for college or I want to buy this house. And so we look at each goal differently. We assign portfolio valuations to each differently and try to get people focused on whether or not they're on track or not.
I do have one last question. Did you fill out your brackets?
I did.
Because Katie missed the deadline there.
I did.
I assume you're busted like everybody else.
No, to my family, I am #1 in the bracket right now.
Okay,
so
all
I
right.
hope my son and daughter are watching.
I hope you have some money on the line. Kristin, it's really great to see you. Thank you for your time. That is Kristin Lemkau. She is CEO of JPMorgan Wealth Management. And speaking of these markets, let's take a quick check on the S&P 500 now. At session lows remain down about 1.7%. The sell-off continues.
A direct correlation between what we're seeing in the Treasury space with higher yields and, of course, what we're seeing in energy with oil prices.
Absolutely. Well, coming up, we're going to take stock of a housing shortage and a retail boom. Chad Tredway, he is global head of real estate over at JPMorgan Asset Management, reveals the key trends to watch in real estate. We'll have that conversation when we return. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on this sell-off underway when it comes to the equity market, when it comes to the bond market. Also keeping, though, a close eye on real estate and that AI build-out, which is continuing still.
Well, we've been talking a lot about that on the show, and there was just a big announcement today. Another project set to kick off in Ohio. That's been where all the focus is. But we've also talked on the show a lot about retail, and apparently there's been a little bit of a revival in the retail space as well when it comes to real estate.
People want to go out, they want to feel the shirts.
Who are these people?
I don't know.
Yeah,
I you know, but people be shopping. Let's talk
young people.
Let's talk a little bit more about this with Chad Tredway. Of course, he is global head of real estate over at JPMorgan Asset Management. Chad, great to have you with us.
Great to be here.
Romaine led us there, so let's start there because I'm taking a look at your notes, and you make the point that e-commerce, it's fading a little bit relative to people going out to brick and mortar stores.
So true. The market's changing. So 5 years ago during COVID, people shopped online and everyone loved e-commerce. Fast forward to today, e-commerce sales and brick and mortar sales are converging. And what's happening as well is that what's interesting is a third of e-commerce sales are actually delivered now through a retail location. So what we found is that you can't buy the same real estate you bought 5 years ago today. You have to be much more thoughtful. 5 years ago, you could buy a large warehouse. Today, not so much. We focus on powered industrial.
Interesting. Well, talk us through a little bit more what that means tangibly, because my next question was going to be, you know, how does a retail investor sort of get exposure to that? Is it as simple as, you know, investing in a mall or a department store? What's the trick here?
So it's interesting. There's a K-shaped recovery, and we've all talked about that many times on the show. We do it in two ways for retail. One is focusing on the high end of the market with luxury. Fortress malls, high-end tenants, very exciting. We see incredible sales, higher than what they were before COVID. We also focus on grocery-anchored strip centers. which has been exciting, where people go to get groceries, get their nails done, have a coffee. Those have been the places that investors can really invest with us and across the platform, and they've seen outsized returns.
I am curious about the geography of all this. Let's start, first of all, on the luxury side. I mean, is this primarily concentrated in big urban centers like New York or LA, or is it a little bit more disparate than that?
Gateway markets, high median incomes, that's where we tend to see the most sales, the most return, and the most concentration.
Okay, and then with regards to the other side of that coin, with regards to some of these grocery strips, where are we talking?
More dispersed. So tends to be renter by need locations, high density, places like Queens or the Bronx or Brooklyn is where we tend to see really good sales in grocery anchored strips.
Are you finding, though, is there, in terms of pricing, meaning if you were entering into these markets right now, is it favorable or has it gotten crowded? I know we've had you on this program before talking about the AI side of the business and how, some of the asking prices for, just even a simple parcel of land is through the roof. Have we reached that point yet with retail?
So we are seeing the market start to heat up.
Yeah.
And transaction volume across all real asset types is much higher. In fact, it's up 75% from the trough, which is amazing. The market's noticed that real estate is recovering. We're now in our 8th quarter of positive returns across our $81 billion portfolio. So those that will win on pricing and drive the best returns have scale and relationships to be able to find these unique deals.
I do want to talk about residential a little bit here because, the idea that there's a housing shortage in this country has been well socialized at this point. You still hear a lot of bullish commentary when it comes to multifamily homes. I wonder, if that's something, if that's a cry, you would mimic as well.
I think we've talked about it here before. We need a few million housing units just to meet demand. So think about that. And it's everyone knows really around the country housing affordability is a major issue. So we want to be part of that solution. In fact, we actually build single family housing. We add to the housing supply. We focus on the middle class in the United States, and we see great rental returns and investment returns by doing that. I think what's fascinating is we just need so much supply because the first-time home buyer was 35 years old just a few years ago. Last year, it moved up to 38 years old. Today, it's 40 years old to buy your first house. So the only way to make things more affordable is to add new supply.
Yeah, it's pretty striking, some of those statistics when you think about first-time home buyers. But let's talk a little bit about seniors, though, because I see that's an area you highlight as well. Certainly something we've heard before. I mean, when it comes to, the older part of the population, what exactly does the opportunity set look like there, and how has that changed over the past couple of years?
America is aging. And so as we think about what we did 5 years ago versus what we do today, we're much more focused on age-restricted housing. In fact, we see some of our biggest returns there. These demographics are wealthy. They've got capital to spend. They want amenities. They want to be in great locations. And so we found that as America ages, they need housing, and that's a key theme that we focus on.
Is there, though, I know there's the need for it, but there's been a lot of talk as to why we're not seeing a faster build in that. And I'm curious if what's holding that back. Is it because of the cost to build? Is it because of regulation? What?
Construction costs are incredibly high.
Yeah.
They've almost doubled coming out of COVID. So that's one piece of it. I also think the market's waking up to the demographic trends that population is actually going to shrink over time if you look at estimates, and therefore you're now seeing capital go to age-restricted housing.
And so, just to be specific, when we're talking about age-restricted housing, are we talking like 55-plus
Typically 55-plus communities with a lot of amenities in great locations. Tends to be high-income locations where people love to be. It's either warm weather or a great cultural center, things like that tend to do the best.
Before we let you go, I mean, I do have to get your thoughts a little bit more directly on what we've seen with the AI and just call it the broader sort of tech data center boom. There's been a lot of concerns about not only just how maybe it got a little bit too heated, but the idea that there might be some cracks in it with regards to an imbalance right now between supply and demand. I know in the past you've said that you didn't find that space as attractive as maybe other folks. You still feel that way?
We focus on it. There will be winners and losers. When you think data centers, people think power. When we look at that, there's more than one way to play it. So advanced manufacturing facilities with 4,000 amps of power saw over a 10% return last year versus those that had less. So we find advanced manufacturing giving the flow of capital into manufacturing supply chains in the United States to be the #1 way to focus on playing kind of this AI advanced trend because they've got robotics, automation inside of the manufacturing warehouses, which is very exciting for our investors.
All right, Chad, always a pleasure talking to you. Always great insights. Chad Tredway is the global head of real estate over at JPMorgan Asset Management. Now, Katie, we need to turn back to the broader markets. As he was speaking, stocks now hitting fresh session lows with the S&P down about 2% here on the day. It's interesting because we haven't seen a meaningful increase in oil prices. They've kind of been camped out where they were for the last couple of hours here, but clearly heading into the weekend with a lot of risk on the table. Obviously, it's also triple witching, so you have a lot directioning going on into the close as well, and that's really starting to stir up volatility.
Absolutely, but then you take a look at the bond market, you know, not necessarily impacted directly by triple witching, but certainly quite the sell-off that we're seeing when it comes to the long end of the curve. The 10-year Treasury yield higher on the day, looking at its steepest levels since about April or so. We know that when it comes to rate cut bets, they've been totally removed for 2026. And, you know, some prominent voices out there talking about the possibility of rate hikes. Maybe they should at least be in the conversation.
Absolutely. And just keep an eye on the cross asset. We should point out the VIX now spiking higher as well, right around the 29 mark. That's also around the highs of the day. And I thought it was interesting, too. I mean, all of the major equity indices right now are at their 200-day moving averages or below it. And it looks like they're going to close there, borrowing some huge dip buying in the next 20 minutes. Yeah,
it's going to be interesting to see what that means, that 200 daily moving average being tested, whether that's going to act like a support level, or if we do break through, does that mean there's more room below? This is definitely one of those times where we start to talk about technicals.
Absolutely here. One of the broadest sell-offs that we've seen all year long in the S&P. But when we come back, we're going to talk about one particular stock, and it's plunging and has nothing to do with what's going on in the Middle East. We're talking about super micro, and a smuggling case that everybody has their eyes on. That's our stock of the hour, and it's up next right here on Bloomberg. Markets on edge, stocks at session lows. The President of the United States speaking with reporters outside the White House.
Mr. President, the relationship's a very good one, I think so. Mr. President, we want more or less similar things. You know what we want? We want victory, both of us, and that's what we've got. Mr. President, how will the operation? Well, you know, I may have a plan or I may not, but how would I ever say that to a reporter? If I said that to a reporter, Marco would say, "Please, sir, let's bring you over to the helicopter immediately." Right? No, I can't tell you that. It's certainly a place that's people are talking about, but I can't say. Yeah.
Are you ruling out
how will the Operation Epic Fury affect talks with Russia on Ukraine?
What about it?
Are the talks on back burner right now because of
no,
We're talking about it. I think it'll get done. When do you expect the next round of talks to take place?
They take place almost every day. We're making a lot of progress.
You said that the war was militarily won in Iran. What did you mean by that? You said the war was militarily won in Iran. What did you mean by that?
Oh, I think we've won. We've knocked out their Navy, their Air Force. We've knocked out their anti-aircraft. We've knocked out everything. We're roaming free. From a military standpoint, all they're doing is clogging up the strait. But from a military standpoint, they're finished.
So how much longer should the American people expect?
You said opening the Strait of Hormuz is a simple military maneuver.
Very simple.
Yeah, but what did you mean by that?
It's a simple military maneuver. It's relatively safe, but you need a lot of help in the sense of you need ships, you need volume. And NATO could help us, but they so far haven't had the courage to do so. And others could help us, but, you know, we don't use it. You know, at a certain point, it'll open itself at a certain point. But we've defeated the enemy, and they are an enemy. They're a sick group of people. The leadership is gone. The Navy is gone. The Air Force is gone. The anti-aircraft equipment that they have, the radar they have is all gone. Everything's gone. The strait itself, the actual strait, how are you? The strait itself is, we're doing a good job. But it would be nice if the countries, including China, if the countries that use it, China uses it 90% of their energy. Japan is 95% of the energy. It would be nice if those countries would get involved. What? I thought she did a good job yesterday.
Lindsey Graham has asked for you to reconsider the American bases in Spain, in Germany, after what they have done in the Strait of Hormuz. What's your take?
Well, it deserves. He's right about asking that, and I think NATO's gone down a long way because they haven't. I mean, they should be helping with the Strait. They get much of their energy from the Strait of Hormuz, and if Lindsey Graham said that, and don't forget, he was the big NATO guy for a while, and now he's not. And a lot of senators and congressmen, they're very upset with the fact that NATO has done nothing.
Pope Leo is calling for a ceasefire. Pope Leo is calling for a ceasefire in the Middle East and to reopen dialogue. What do you say to the Pope?
Well, look, we can have dialogue, but I don't want to do a ceasefire. You know, you don't do a ceasefire when you're literally obliterating the other side. They don't have a Navy. They don't have an Air Force. They don't have any equipment. They don't have any spotters. They don't have anti-aircraft. They don't have radar, and their leaders have all been killed at every level. We're not looking to do that. Thank you. Thank you.
Chuck North. Chuck North.
I bet he was a great guy. Wow. The guy in the house was moving along. He was like corner third. Yeah, he was Chuck North. He was a great guy. He was a really good, tough cookie. He didn't want to fight him. He was a tough, great guy, and he was a great supporter. Wow. That's a good man.
And right now we are watching President Donald Trump walk on the White House lawn to his helicopter on his way to Florida alongside Secretary of State Marco Rubio, peppered with questions, Katie Greifeld, from reporters asking about the situation in Iran. The president saying in his words that, quote, "We've won." When asked about the Strait of Hormuz, he said that all Iran is doing right now is clogging up the strait and that NATO should be helping to open it up. But according to Trump, he says that at a certain point, quote, it will open itself.
Yeah, a lot to dig into there, specifically when it comes to Iran, where they stand militarily. He says that from a military standpoint, Iran is finished. And his last comment there at the end that they're not looking to do a ceasefire with Iran, that they can have a dialogue with Iran, but that Trump does not want to do a ceasefire here. So certainly tells you where we're heading as we go into this weekend.
And a lot of people, we talk about this war that kicked off effectively 21 days ago, February 28th, to be specific. And a lot of investors had sort of looked at this and thought this will be short, given the power of the U.S. military. But obviously, this isn't really as much about what the military is doing. It's more about the idea of energy infrastructure, the flow of oil and other energy products out of the Strait of Hormuz, out of the Persian Gulf. And also now, as we've seen with the volleys from Iran into some of its Arab state neighbors, this idea of some of that energy infrastructure now being damaged to the point where it might not actually be fully functional for months and in some cases years.
Right. I think the concern has broadened and deepened in some cases because there's still a lot of focus when it comes to the actual flow of energy through the Strait of Hormuz. But to your point, you know, you've seen this more durable rise in oil prices because there's a lot of concern about exactly that the infrastructure will be damaged to the point where it will take years potentially to get it back up and running. And certainly that is going to have much longer lasting impacts than just the flow of oil being temporarily blocked here.
And our editors here at Bloomberg News flagging to your attention, reiterating what we just said, the redhead crossing the Bloomberg terminal, that President Trump says he doesn't want a ceasefire with Iran. Now, how that folds into the markets, Katie Greifeld, with a huge sell-off here into the close. But also just to point out what we're seeing in energy prices. Brent crude remains elevated, $112 a barrel. But I really want to point out some great reporting by Javier Blasa, one of our Bloomberg oil analysts, has really talked about, really pay attention to those refined products. Prices at the pump here in the United States, $4 a gallon on average, just for regular fuel. Diesel fuel now around $5. And of course, when you go overseas into Europe and Asia, the price increases are way more extreme.
Absolutely. Yeah. That's the thing that, you know, you think about the effects happening here in the U.S. We've had this conversation on the close. It's Europe, really, and some of those other regions that you mentioned that are feeling the brunt much more acutely, perhaps. But still, you start talking about $4 a gallon when it comes to gas prices. Obviously, that is going to have an impact on the midterms coming up in November. And it's working its way through these markets as we speak right now. The S&P 500, again, looking to close on a fourth straight week of losses.
Yeah, and $4. Remember, that's the average. Of course, so there's been a lot of screenshots on social media. People are showing what their prices are at their gas stations, $6, $7, in some cases $8 a barrel if you're out there in California here. And that really has now become the story. This isn't just about the energy price spike. It is about those second order effects, how it trickles down to those other fuels, those other derivative products, and of course, how it eventually, if at all, trickles into the economy. Joining us now to talk a little bit more about this is Kathryn Rooney Vera, Chief Market Strategist at StoneX Group, helping us count you down to the closing bells with just 10 minutes to go. And Kathryn, I think it's fair to say this is a market on edge right now. What, if anything, would settle it down?
Well, the only thing that I think can settle it down, Romaine, is when Lloyd starts to, ensure tanker crossings at a normal rate. That's a security issue, and that's not going to change for the foreseeable future. But that's, I think, ultimately what changes the story. But right now, I think the markets are beginning to price what I think is going to be a stagflationary impulse manifested very soon. But I still think we're expensive. I mean, when you look at where the S&P was trading before the Iran situation, we were trading at 22.2 forward earnings. I took a look, Romaine, at the past several oil shocks over the recent decades, and that is 80% above the 12.4 times median at the onset of every major oil shock since 1980. After 4 weeks of selling, it now sits a little lower, 20.3%, but the 10-year average is 18.9, so we're still expensive.
We are expensive. And I also just want to point out for our readers and for our viewers, too, that we had actually seen some increases in energy prices prior to the actual war starting. And I think people forget that as well. We had started to see a creep up in oil. We had started to see a creep up in fuel prices. But there's another component to this that a lot of people have talked about. The idea, there's a lot of other things that come out of the Persian Gulf. Obviously, a lot of chemicals that are used to fertilize our crops and plants in what is supposed to be a very critical spring planting season, aluminum and other metals and other commodities as well. Do we have any sense here as to whether we should now prepare ourselves for additional strain outside of just oil and gas?
You teed me up nicely, Romaine. Everyone's watching Brent at 107. I'm watching Uri at $665 a ton. It's up 40% since February 27th. And we at StoneX, we have a huge commodities component of our firm, but we called this on day 4. So on March 3rd, we said, guys, the sleeper risk here is fertilizer. It's not a fun or sexy topic to talk about, but fertilizer has a calendar constraint that oil does not. The Northern Hemisphere planting window opens in about 4 weeks. It's not something you can delay. It's either you plant or you don't plant. So if this obstruction of the strait, through which 30% of fertilizer, seaborne fertilizer passes, if it goes beyond the planting season, it's a lost season. You can't plant corn in June and expect to harvest in August or September. So I did some work on this. What does this tell us? So yeah, everyone cares about oil and gas at the pump. I care too. But food at home inflation impact, that could be big. We could be talking 2 percentage points for the US. We could be talking 4 to 8 percentage points in the most vulnerable regions like Africa, which is very vulnerable. So I think, there are some really important things to consider here. And, food outside of the home does go into core PCE. Right. And consumer inflation expectations matter as well. So I think this is going to change also the trajectory of the Fed.
Absolutely. So, I mean, fertilizer, not sexy, but important. And you lay out very neatly why. I'm wondering, what that means for portfolio implications. How do you invest around that idea? You mentioned the Fed, for example, are ways into it. But is there a more direct way to reflect some of those risks when you're shaping your portfolio?
Yeah, I think, we've had this 15-year trajectory of U.S. exceptionalism. It still remains intact. But I think that the past 1 year that we've seen of international stocks outperforming U.S., I think that's the beginning of something structural. So what I'm telling our people and our clients is to overweight commodity exporters within emerging markets, specifically Brazil and Argentina, go long international over U.S., long gold, hold on to gold, quality credit over high beta, and use any near-term dollar strength as a better entry point into international. So I think that we're going to see some weakness on the margins here. I think valuation has not mattered for 3 years, but in a world where the Fed cannot cut and God forbid has to hike or thinks about hiking, which they are thinking about hiking, then I think earning estimates come down. And that's the only thing that matters.
And I do want to talk a little bit more directly about oil here, because of course we just heard from the president some additional comments from President Trump saying, I thought oil prices would go higher after strikes. Also that I expected worse. Again, that is President Trump talking about the reaction in oil markets to, of course, the actions in Iran. Do you agree with that? Or, you know, what you're seeing in oil, where does it stack relatively to the scale of what we see unfolding in the Middle East?
Well, it certainly always could have been worse, I suppose. I mean, we're at 107 on Brent right now. It could go higher. It probably will go higher if the Strait of Hormuz doesn't reopen. Natasha Kaniva at JPMorgan did this excellent exercise, so I'm going to quote her, but she counted the days. So every GCC country has a storage capacity limit. So once you meet your storage capacity, you can no longer produce. And that limit is approximately, let's call it on average, about 28 days. We're coming up on that now. So certain GCC countries have already hit storage capacity. They're going to reduce their production. So for every 1 million barrels per day reduction production, it can add $4 onto oil prices. So the longer this goes on, the higher oil prices can rise.
I do want to talk about a little bit more, Kathryn, about kind of the interplay of what is now dollar strength coming off of what had been for the last few years a story of dollar weakness. So the dollar basically rallying against every major currency out there, if you will, most notably the franc, the yen today, the Swedish krona, the New Zealand dollar, and we're not even getting into some of the emerging market assets. You said that it could potentially be the benefit for non-U.S. assets, correct?
Yeah, I mean, I think that if you have a stronger, you know, if you have a scenario where Brazil and Argentina are net crude exporters, and you want to overweight commodity exporters over importers, this is a good opportunity for you to do so. And I think that, you know, EM has still a ways to catch up. So for sure, I think there's opportunities internationally. I mean, Japan's certainly expensive. Europe still could go a little ways more, but I specifically like emerging markets and especially those commodity exporters.
All right, Kathryn. Always appreciate your insights. Kathryn Rooney.
My
Vera,
pleasure. Thanks, Romaine.
Chief Market Strategist over at StoneX Group. And Katie, it looks like the losses that we had coming into the start of this program about an hour ago are going to hold into the close, setting up now for one of the worst weeks that we've seen in quite some time.
Absolutely. We are bouncing a little bit off the lows here, but as we've been talking about, it is triple witching. We do have a lot of options expiring. So you're seeing that reflected in the movements and also in the volume right now.
Absolutely. Volume picking up as we head into the close. A lot of questions here about the exposure that you may want or may not want heading into the weekend. We're going to break down all of this week's market action with our global simulcast now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube here on an incredibly volatile day in financial markets. Carol Massar, it's not just equities, it's everything in between here. Yeah. A market that continues to be bounced around by the situation in the Middle East.
Yeah, I mean, I had so many names that are on my gainers list. I'm kind of crossing fingers, but the unbelievable swings that we've seen, and we have so many questions going into the weekend. I mean, do we see the administration, the president just talked about it, in terms of boots on the ground? Does that potentially happen still? Do we see Carg Island, so incredibly important when it comes to exports out of the region? And so does that happen, and just more disruption to the global energy trade? So I think, yeah, you're definitely seeing a risk-off trade here going into the weekend.
But it bounces, you see there from the S&P, as you mentioned earlier, Carol, off its lows. It was down as much as 2% earlier. But as Carol mentioned, energy certainly the focus. WTI at 97, so off its highest levels of the day. Same with WTI, or same with Brent rather. It was up as high as $113 a barrel, now up to $112 a barrel. Still, both of those up more than 2%.
And as usual, I'm taking a look at where you can find a haven asset right now. You're certainly not going to find it in the bond market. You're not going to find it in gold. But then you take a look at what's going on in the dollar. The Bloomberg Dollar Index actually managing to put together a gain right now, higher by about 0.5% or so on a very, very risk-off day.
On a very risk-off day here as we parse all of the action that we saw on the day and on the week, and maybe try to make some sense of what to expect when you come into work on Monday. The Dow Jones Industrial Average is going to lose roughly about 400 points on the day, or about 0.9%. The S&P, it's down about 99 to 100 points, or 1.5%. The NASDAQ Composite down to more than 400 points, or 2% even. And the Russell 2000 losing about 56, 57 points, or about 2.3%. I do just want to point out here, Carol, that all of the major indices now are closing either at or below their 200-day moving averages, and the S&P 500 doing something it hasn't done since April of last year, and that's closed below that 30 of that 14-day RSI, a technical indicator of now oversold conditions.
Yeah, that relative strength index, right? That technicians certainly watch. But do we get a bounce, or do we continue to kind of trend even lower from here? S&P 500, guys, so as Romain laid out all the numbers, you're not going to be surprised. 389 names to the downside on this Friday. 114 actually gaining ground. Some decent rallies, Katie. So it's always a reminder that there are names that stand out here.
Yeah, certainly when you take a look at the sector level as well, as measured by the Circle, not a lot of green, but two sectors managing to finish in positive territory. That is financials and that is energy, just barely, but still above the line here, though. 9 sectors in the red. In terms of what your biggest losers were, utilities down by more than 4%, real estate off by more than 3%, and tech as a sector off by more than 2%, Carol.
All right, so this is so indicative of the kind of day that was here. Romain, you talked about the swings, the volatility.
I'm surprised you found gainers.
I am too. Well, check this out. Listen to this. FedEx, it was up 27%, guys, at its highs today.
What?
Wow.
Yeah, and we're finishing with just a gain of about 0.8%.
Barely made it.
Yeah. Barely made it. And the company, we know the story, right? Raising its full year profit forecast. We saw the stock up the most in 10 months before we kind of pulled off those highs of the session. The company talked about restructuring its delivery network, getting traction, a lot of stuff going on. It also says it does not expect the war in the Middle East to have a direct material effect on its business, but the broader consequences, including higher energy prices, volatile shipping patterns, are adversely affecting the global economy. No, come on in.
Just want to say FedEx was up about 7 to 8%. You said 27%. That was the point.
20?
That was a
Oh, I'm sorry.
Yeah, I was like, whoa.
Sorry. I had my screen kind of kicking off.
I hate correcting you, but
no, you love correcting me. 7.6%. I'm sorry. I thought that was a little crazy too, but I had my screen. I only have a little small screen to work with, and I've got a lot of things going on. Yes.
I think all our screens are the same size, are they not? Or
how many? Do you only have one panel in front of you?
Just one.
Oh.
We got to get you another screen. We're going to work on that.
All right.
Yeah.
Can I get another screen too?
All right, TBD. I'm just going to move on. I don't know if anything can save me now. All right, ARM holding. Let's see if I get this one right, because we did see this one holding on to its gain of about 2% here at the close. It too, though, was a lot higher in today's session. In fact, it too was up about 7.8% at its highs today. Okay, so ARM holding was a top gainer in the major averages. HSBC upgrading this one to a Wall Street high price target, raising it to a street high of $205 from $90, playing a little catch up there, and says ARM is now firmly in the middle of a transition from being a smartphone-dependent semi-IP play into a major AI server CPU beneficiary that remains undervalued by the market. The analyst, frankly, writing that. And then just quickly, I want to go to Dell. Dell too, that one surging more than 8% earlier in the session, holding on to a gain here at the close, just about 0.5%. And this one really spiked a lot out of the gate. It was a top gainer in the S&P, and basically winning on Supermicro's woes. Dell is a chief competitor to Supermicro, so the Supermicro story, I'm going to pass actually over to Tim, because it just gained Dell as a result of what was going on with Supermicro.
I'm glad you ended with Dell, because I want to.
You're welcome.
I was going to start with Supermicro, but I messed it up. It's okay. I'm going to go to Supermicro now, down more than 33%. Today, which is pretty wild. This is the worst day going back to October 2018. That's when it fell more than 40% in a single day. The U.S. did charge the company's co-founder, Yishayan Wali Lia, with illegally diverting NVIDIA-powered servers to China in violation of U.S. export controls. The prosecutor said that Lia and two others allegedly sold the hardware to a Southeast Asian company and coordinated it for its ultimate shipment to Chinese customers, and they made efforts to evade scrutiny. Supermicro, for its part, said it's cooperating with U.S. authorities and has put Lia and another defendant on administrative leave. And the company stated that the alleged conduct is a contravention of the company's policies.
This story is fascinating, also because of how fast it rose. And remember when it got put into the S&P back in, 2024? There were a lot of people saying maybe that was premature, and now you have this this whole investigation here, raising a lot of questions here about what the future of the stock can be.
Yeah, we had a great chat with Bob Van Voris down at the courthouse earlier today, and he laid out the potential implications for the individuals who've been charged, and that's some serious jail time there. So we're going to continue following this story. I also want to check on the Bloomberg Mag 7 Total Return Index, because every single member of the Mag 7 was lower today. This fell more than 2% as a whole, but as I mentioned, this was what really pulled the market lower today, the S&P 500 and the NASDAQ 100. Also, this is an interesting story. Swarmer, it's a tiny drone software company.
Swarmy?
Swarmer.
Oh, just checking.
Fell 30% today. This stock soared close to 1,000% in the first 3 trading sessions after its IPO. Shows how the war in Iran has reshaped the outlook for the defense industry. Though swings like this echo what was associated back in the day with meme stocks. Romain, you remember those, right?
Yeah, absolutely. I mean, I was paying attention to this earlier this week, and, long term, I guess you can make a bet here that, this is the future of warfare, these sort of smaller, cheaper drones. But, like I said, to get that kind of pop coming off of that IPO seemed, a little stretched, to say the least.
Some might say frothy.
Some might say. I would not say that.
I'm not saying it.
Yeah, I'm not saying that either. I do want to just turn real quickly to what we saw in the yield space here. The sell-off continued in a huge way here. On the short end of the curve, of course, everyone now pricing out any chance of a Fed rate cut this year. 9 basis points on the day for the 2-year, but we should just point out for the week, we're up something like 17 basis points here. So this gets to the idea of where investors' heads are at when it comes to yields. But really, it was a parallel shift, not only on the day, but really on the week as well. Your benchmark 10-year yield up 10 to 11 basis points on the week, 3rd straight week where we've seen double digits out there on that basis points, or I guess what is that? I mean, it's technically not double digits, but you know what I mean. 20 basis points, 14, and then this week now 11.
And it's pretty wild to think that just 2 days ago we had a Fed decision. We heard from Jerome Powell, and bond traders' thinking has changed so much since then. Now the possibility of a rate cut in 2026 being totally priced out. And as I mentioned, the U.S. dollar seems to have been the big beneficiary of that. I'm taking a look at the CFTC positioning data, and you have hedge funds and other speculators actually flipping positive on the dollar for the first time this year. Certainly a sign of the times when it comes to the current thinking around how what's going on in the Middle East with oil prices, how that's going to shape monetary policy.
Yeah, I mean, it really comes down to timing, right? Like when, everybody keeps talking about the timeline. You even got that from Fed Chair Jay Powell, essentially. Like, you can't make predictions. You can't really figure out the outlook until you know when this is done. And I think this is going to be an interesting week. And we had a conversation with a guest just talking about potentially the escalation of this war. And I think it just comes down to that.
Well, I don't know. Did you get a chance to listen to some of the comments that the president made as he was walking to the helicopter? I mean, it didn't sound like, at least based on what he was saying, that we're at the end of this anytime soon. I mean, he says, okay, we won. But then, of course, when asked about whether it would be a ceasefire, said it's off the table. As far as the Strait of Hormuz, he just seemed to say, well, it'll open at some point, which is not necessarily what the market wants to hear.
Why are we asking for $200 billion more from Congress if the war is coming to an end or if we're in a good position? Obviously, so something that'll continue into the weekend.
They should put you on the side of the helicopter and yell questions at him.
Just don't ask me to talk about highs of a stock, because I apparently get that wrong. Have a good and safe weekend, guys.
You too.
Mean it. That is it. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Romain and Katie, of course, continuing there on The Close on Bloomberg Television. Tim and I back here on Bloomberg Business Week Daily on Bloomberg Radio. We will see you again, same time, same place on Monday.
And our coverage continues here on Bloomberg Television. We've been talking a lot about the signals coming out of the energy market. When we come back, we're going to talk about what we're learning from the fixed income market. David Forgash, Managing Director and Portfolio Manager at PIMCO. He joins us after the break. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic here on this triple witching Friday. Investors had a lot to be spooked about, but it really had less to do with the expiration of those options. Still some concern right now about the third straight week now of the war in Iran, entering a fourth week, and stocks as a group now down for a fourth straight week. The S&P losing about 1.5% on the day. The Russell down about 2% on the day, right at its 200-day moving average. And the S&P, we should point out now, in oversold conditions below 30 on that 14-day RSI. But of course, all the focus in this market has been on what we've been seeing in the yield space and in the oil space. Extreme moves once again here on this day and on this week.
And what you're seeing with oil helps explain what we saw in Exxon, one of the few companies that managed to squeak out a gain today on this Friday, higher by just about 1%. But I put Supermicro up at the top. We have to talk about it, of course. That 33% drop. That's after the company said that 3 people associated with the company received indictments. You can see the reaction in shares. And then NVIDIA here at the bottom, one of the biggest weights on the S&P 500, down about 3%. But let's get to our top story this hour, and that is fresh turmoil in the Middle East, sparking fresh losses in stocks and in bonds. Now that drop in equities deepening after CBS reported that the U.S. is preparing to deploy ground forces into Iran. Meanwhile, you have bond traders erasing their wagers on a Fed cut this year. Now that wipeout comes as a chorus of central bank chiefs warn of inflation, with oil surging, Romaine, and a lot of questions about what that means for the Fed.
All right, well, let's get some insights out of David Forgash, portfolio manager over at PIMCO, joins us here in studio, too. And I am curious about the move in yields, which was relatively parallel across the curve. And I'm just curious what that says to us. I know on the short end, everyone's pricing out the rate cuts, but when you also see a similar move higher on the longer end, what does that say?
Well, there's certainly concern about funding just in general. So, I mean, when you're seeing the curve move like this, or the treasuries, I mean, you're also seeing the rest of treasuries and credit move wider as well. So it's a feedback mechanism, and you would expect to see something like that when you've got the volatility that is being associated with war right now and supply chain disruptions.
Are you seeing that same type of volatility in the high-grade credit market, or are we still kind of dealing with spreads that are relatively in check?
Yeah, so I actually, if you were to say that that oil was up above 100 and that there was all the other issues that are going on at the same time in the market, you know, concerns around the Fed and things like that, I'd be actually surprised that spreads aren't even wider. They've held in exceptionally well. Part of that is due to the makeup of particularly the high yield market, but the market in general. Like the high yield market has much higher quality than it had ever been in the past, so it's insulated a lot from the turmoil that you're seeing in other markets like private credit or even leveraged loans.
Well, it's interesting. You mentioned, you know, spreads have held up relatively well against the backdrop of much higher oil prices. Some people would look at that and say this market is complacent. It sounds like that's not what you're saying.
No, I actually think the market is a bit complacent. I think the market, I would expect to see volatility continue. And that you would see spreads back up further. However, when you're looking at you have to look at each market in particular. If you look at high yield has the largest sector is energy. So it's a direct beneficiary of what you're seeing in oil prices. It's much different than what you'd see in other markets like private direct lending or leveraged loans, where it's very small.
Well, let's talk a little bit about the private markets, because, I mean, even before February 28th, you saw a lot of concern in what was going on specifically in private credit, specifically for those with a lot of exposure to the software space. And I'm curious, you know, even though we have these competing narratives right now, geopolitics and what's going on with the AI trade, particularly when it comes to private credit, I mean, how has that developed over the past 4 weeks? Where do you stand on it right now?
Well, I mean, we've been saying for a while that private credit has some very lax lending standards. Underwriting has been very poor in private direct lending. So when you think of that as the eye of the storm, much too much of it was in software, 25% roughly in software lending. So when you have that type of situation where it's focused in that, and then you have new information coming out as far as AI, which will be changing considerably even over the next few years. It brings a lot of doubt into the market like that. But then you look through, and you can look at other markets like high yield or leveraged loans, where there's a smaller percentage of AI, so or software. So software is very small in the high yield market. It's only about 4%, and it's about 15% in leveraged loans. So. Yeah.
I know there are some people who are kind of looking at also as opportunities in this space. The idea that, okay, you know, now that you've seen maybe potentially the baby being thrown out with the bathwater, you can maybe come in and find some bargains. But one of your colleagues earlier this week kind of said that at least right now, he's not seeing a lot of opportunity there. And I am curious as to whether you see that might actually open up where maybe some of the conditions, at least based on what we can see publicly, has been maybe a bit oversold.
Yeah, I mean, there will certainly be oversold conditions. I don't think we're there yet, but what we're seeing come out right now as far as the loans that need to be sold, starting with some of the least creditworthy is what seems to be coming out. There's a lot of BDCs and a lot of private direct lenders that need to reduce their positions, so they're starting with some of these loans that, quite frankly, do not have the yields that are attractive when you consider the amount of risk that's involved in them.
Does that risk now seem even more heightened given what's going on in the Middle East and the idea that the second and third order effects into the economy might start to show up soon?
Absolutely, and when you think about what's going on in the Middle East, it's obviously it's oil prices, which leads into other things like fertilizer. It's also just a supply chain disruption. I mean, the amount of ships that can make it through, the cost of the supply, the cost of sending out those ships, they've gone up by 6 times to send out a ship with oil, and then the other things that are sent over, like parts for communications, parts for technology, all of that feeds into it. It's first seen in companies when they start talking about their supply chain disruption and the costs that go into producing their goods.
And so again, if you were, wrapping this into a portfolio, this view on energy, it sounds like you're going to find that in the high yield markets. I do want to talk a little bit more about what we're seeing in the private side of things, because you think about, particularly when it comes to investment grade credit, there is that concern that you're going to see some of that turmoil in private credit start to infect the IG space. I mean, is that a narrative that you subscribe to as well, or is the daisy chain sort of not as direct?
All the markets are interlinked. And we started by talking about treasuries, right? So all of the markets are interlinked. It's not like you can affect one with nothing on the others, but they're completely different as far as the risk that are involved in, say, private direct lending and the full other side, which is investment grade or even high yield. So it's almost like a stone being thrown into the pond. They're going to have a ripple effect, but it'll be much less in investment grade. Investment grade are big companies, just like high yield, but big companies that have strong balance sheets mostly, and that's why they're investment grade.
Well, to your point that, everything is interlinked here, let's go back, of course, to treasuries, and let's go back to the Federal Reserve, because, okay, we've seen rate cut bets be totally evaporated over the past couple weeks. Now the conversation of a rate hike is happening once again. If we actually saw that play out, if the Fed did have to raise interest rates, I mean, how does that affect the conversation that we're having right now? I
mean, so when we're thinking about oil prices and we're thinking about the supply chains I was talking about, that all feeds into inflation, right? So that is clearly why there's more on the table, the potential for the Fed to hike rates. If that was to come to fruition, it was come to, you would see markets sell off further. They'd be very nervous about that, right? So even the idea of inflation, would rather see the Fed fighting against inflation if it was coming out, wouldn't want them to do nothing. But at the same time, when you have a fear of inflation, it hurts borrowers and it hurts the value of the fixed income. But we don't expect that to come to play. It's very early to bring that up at this point, in the argument.
Absolutely. Well, David, it's really great to get some time with you. That is David Forgash. He is a portfolio manager over at PIMCO. Now, coming up, President Trump saying moments ago that he has no plans for a ceasefire with Iran. We'll dig deeper into the president's remarks when we return. This is The Close. President Trump speaking to reporters moments ago, saying he does not plan on calling for a ceasefire with Iran and that he expected the impact on energy prices to be worse? Let's discuss with Bloomberg's Balance of Power co-host Joe Mathieu. So, Joe, a lot to dig into there. President Trump saying that you don't do a ceasefire when you're literally obliterating the other side. We also heard from Iran, an Iranian official earlier today, saying that Iran is unwilling to discuss Hormuz while under attack. You add it all together, it doesn't seem like an end to this conflict is imminent.
Well, no, and that's kind of the feel in the markets today. The last 24 hours have brought a very different vibe here in the way people are looking at this in terms of timeline, that it could, in fact, be a lot more protracted than we expected. I don't want to do a ceasefire. He said it. You don't do a ceasefire when you're obliterating the other side. And he also said we don't use the Strait, which is something that we've heard quite a bit lately, suggesting that that oil is going to other destinations, even though, of course, it's impacting global prices. Although he says NATO could help us, but so far they haven't had the courage to do so. This type of language has not been helping the markets feel a lot better about things, obviously. And that exclusive reporting by Bloomberg that you pointed to, Iran saying that it won't even talk about the Strait until attacks against the nation stop, make us realize that this could be a bit longer or a lot longer than folks had suggested, with reporting today that the president is considering putting troops on the ground to seize Karg Island, if not the Strait itself. He did not acknowledge those reports in the driveway and said he didn't want to talk about it when troops came up.
Well, this is what I'm curious about, too. In addition to the comments there outside the White House just a few moments ago, earlier in the day, he also was speaking on the issue, and he seemed to be relatively concerned. Maybe concern isn't the right word, but he had some choice words for NATO allies and the idea that they're not stepping up to open up the Strait of Hormuz. The idea here, as he seemed to reiterate there as he walked towards the helicopter, the idea that it's not really, the U.S. oil that needs to go through the Strait, so why should the U.S. itself be involved? And that's getting to this idea of why the markets, Joe, have been on edge here. Have we heard anything at all from some of those nations as to whether they indeed would try to step up and take control of this situation?
No, and the United Kingdom has suggested that it might send some help at this point, but not to the extent or scale that would be needed to reopen the Strait. And you're right, Romaine. He called NATO a paper tiger and referred to our allies as cowards, saying we will remember. And that's language that we've heard from him before, suggesting some sort of punitive outcome for our NATO allies. But indeed, whatever goes through the Strait may not be headed to the United States, but it does impact the price that we're all paying. And I know that I don't need to explain that to you, Romaine, which is why this market's getting more worried, it seems, by the day.
Just real quickly, Joe, and I don't want to be glib about this. I know we're only 3 weeks into this, but some reporting coming out of Washington, your colleagues, including Jennifer DeLuey, Courtney McBride, and the headline that they have is quagmire, an Iran quagmire. Are we at that point where we can start talking about this 3 weeks in as a quagmire?
I don't think so without actual troops on the ground, which I think you would have to have that element to call this a quagmire. I think the worry is that we're going in that direction. The fact that we are having that conversation here with the idea of hundreds or maybe a couple of thousand Marines landing on Karg Island, that would put them 15 miles off the coast of Iran and would put them in harm's way potentially. Also, the idea of reopening the Strait. The president today, by the way, just now said it could reopen itself. I'm not sure what he means by that. When we talked to Leon Panetta last evening, he said it would involve thousands of troops on the coastline and essentially a no-fly zone. And Romaine, you remember the no-fly zone over Iraq, how difficult that was to enforce and how expensive it was. That would send the price tag of this war much higher than what we've already been talking about.
Absolutely. And of course, the price tag now in the markets already being reflected. You want to stick around here on Bloomberg Television. Joe Mathieu will be back at the top of the hour with Balance of Power, a fuller breakdown here of the military operations and, of course, the political implications. Meanwhile, we keep our focus right now on what's been going on with markets, a big sell-off here in the U.S., but also an even bigger sell-off overseas, both in developed markets and in the emerging market space. And that is where we will turn our focus with Colin Coleman, the former CEO of Sub-Saharan Africa business over at Goldman Sachs. He'll be joining us in just a second, right here on Bloomberg. An awful week for U.S. markets, but quite frankly, it's been even worse for markets overseas. Developed markets taking it on the chin, and since the war started, emerging market assets as a group down almost 10% in correction territory. EM currencies headed for a third down week as more traders now bet on U.S. rate hikes instead of cuts. Here to talk a little bit more about this is Viktor Shvets, global head of desk strategy over at Macquarie Capital. And Viktor, I do want to talk about just sort of the more outsized impact of what's been happening in Iran on emerging market countries as opposed to what we're seeing here in the U.S. Certainly in effect here in the U.S. But we've already seen some Asian nations already start to implement fuel price measures, fuel controls, and take other measures that are certainly going to hamstring to a certain extent their economy and maybe even upend some of the fiscal progress that they make. What are you seeing?
Absolutely. It's all about duration and degree of destruction or imbalance that is going to occur globally. Remember, emerging markets usually would like to have stable global growth rates, stable inflation, very high or as high as you can have trade intensity. How much trade do you get for every dollar of GDP? And they would like to see high FDI, foreign direct investment. What's been happening over the last 5 or 6 years? Combination of economic policy, especially from the United States, but also wars, whether it's Russia, Ukraine, whether it's Iran, are dislocating all of those pillars of emerging markets. But one thing I would add, that the nature of emerging markets also is changing. About 90% of market capitalization of emerging market indexes now are in Korea, Taiwan, China, and India. So in other words, we know developing countries are not the same as emerging market assets. A lot of vulnerable emerging markets are not in emerging market indexes. So increasingly EMs as an equity class is driven more by technology than it is driven by economic cycles.
Well, but the economic cycle has to have an impact. I mean, you mentioned Korea, obviously a huge manufacturer of chips, and we've seen the potential impact on the chip sector by, well, at least for what right now is constrained supply of some of the chemicals needed to make that. And of course, there's the manufacturing issue with China. You're concerned right now?
Yeah, absolutely. But those sorts of things impact everybody as well. This is not exclusively emerging market problem. Even in the United States, which is energy independent. Remember a couple of things. Number one, we pay the same prices globally. We have a global oil price. Number two, we are not using energy usefully. In a sense, we are much more energy intensive than Europe or Japan is, for example. And number three, remember what drives U.S. economy. It is driven by low personal saving rates against very high asset prices. So if you have a different interest rates and inflation, asset prices goes down, consumption can contract in the U.S. a lot. So when people say, quite justifiably, emerging markets are affected, and that is very true, don't forget that there are vulnerabilities, significant ones, that you have in Europe, you have in Japan, and even in self-contained United States.
I do want to talk a little bit about the FX markets and how it's been dealing with some of the ripple effects of what we're discussing here, because, you know, we mentioned earlier in the show that you take a look at positioning right now, according to the CFTC, speculators flipping positive on the dollar. It's one of the few asset classes that has outperformed over the past month or so. On the flip side, you know, the FX market, it's a zero-sum game. We know that EM currencies have been sort of suffering on the heels of that. But I wonder if that's more a story about dollar strength than it is really about EM currency weakness.
It is totally dollar strengths. In a sense, the question is American exceptionalism. Is it sunsetting? Is it fading? Extent to which U.S. financial assets should be in excess of U.S. economic weight. Because remember, U.S. financial assets are 3-5 times larger than the economic and trade weight of the United States. What started to happen over the last couple of years, gradually U.S. started to fade. Now, I think the first 12 months of the Trump administration accelerated that pace. And so people started to diversify, not selling U.S. by any stretch, just diversifying. What you've seen after the Iran war is a reversal back to original plan. And the original plan, the only valuable assets are U.S. dollar, treasuries, and staples and defensives. And that's exactly what you're seeing. That's a strength of USD rather than necessarily weakness of emerging market currencies.
That's interesting to hear you say that. You know, I track exchange traded fund flows very closely, and you take a look at some of these EM funds, you're still seeing the money pour in. So you haven't necessarily seen folks being spooked yet, but it sounds like what you're saying is, you know, that might happen in the future here.
It could. And by the way, emerging markets, if you're saying over the last 12 months or so, outperformed developed markets by at least 15, 16%. At one point, it was more than 20. If you take out China and just look at emerging market excluding China, that is over 20% outperformance. And remember, where it came from essentially is Korea and Taiwan. That's your tech cycle driving that outperformance. So when I look at emerging markets, I agree, people are not panicking yet. There is no withdrawals yet. It might happen at some point in time, but at this stage, the numbers are still okay.
A lot of the focus on emerging markets, certainly since the war began, has been on other emerging markets in Asia, to a certain extent Africa. I am curious about Latin America, given some of the energy issues that were already present prior to the Iran war breaking out. Any concern there?
Well, again, the biggest market there is Brazil.
Yeah.
And Brazil is in many ways self-sufficient, just like the United States. So extent of the challenges are limited. One thing to remember, compared to all other emerging market incidents, EMs today are incredibly well positioned in terms of external vulnerabilities. What used to happen in 2016 and 2013 and 2008, all the other periods, we had a massive vulnerabilities, particularly in Latin America, parts of Central Europe, parts of Africa, even in Asia Pacific. Today, those vulnerabilities largely do not exist. You could argue emerging market countries relearned the lessons or overlearned the lesson. They've actually been very conservative how they manage external vulnerabilities that they have.
All right, Viktor, got to leave it there. Really appreciate your time on this Friday afternoon. That is Viktor Shvets. He is Global Head of Desk Strategy over at Macquarie Capital. Meanwhile, let's keep the conversation going because Ghana is the world's best performing market since the start of the Iran war, sitting on a roughly 20% gain. Our next guest has spent years shaping African politics as a banker, academic, and thought leader based in South Africa. Joining us live, I'm pleased to say we have Colin Coleman. He is former CEO of Sub-Saharan Africa at Goldman Sachs and current non-resident senior fellow with the Atlantic Council. Colin, it's great to see you.
Great to be on your show.
So let's talk a little bit about the continent and start broadly here. When you think about the African economies and you think about what's unfolding in the Middle East, the geopolitics of it all, but also the impacts that we're seeing in the energy market, how does that affect, again, the economies in Africa?
Well, the short-term impacts of the Iranian war are quite devastating for African markets because the inflation shock, with the exception of some oil-producing countries like Nigeria and Angola, the inflation shock is going to be very devastating to the cost of capital, interest rates, and through that, the preparedness of African markets to deal with that crisis. They were, in effect, many of them coming out of a long period of post-COVID difficulties. And essentially, the interest rate cycle and the inflation cycle in those economies was getting under control. So the oil shock now is very, very difficult. So a place like South Africa, there were a lot of green shoots emerging through the structural reforms in the logistics space that were being undertaken. And I'm afraid that these green shoots are going to face very difficult conditions and may not weather the storm, depending on how long the Iranian conflict is maintained. If it's 3 to 6 months, as I've heard today might be the case, that sustained oil shock will be devastating for these economies.
Yeah, that's sort of what I was wondering. I mean, how great is the setback here? And you think about, you know, the different economies where you were seeing those potential green shoots. I mean, which countries are particularly vulnerable?
I would say South Africa, Kenya, Egypt, these larger countries that are not oil producing are particularly vulnerable. We talked about in South Africa, the Minister of Finance produced a budget which was forecasting 1.5% growth for 2026. I think most economists now are revising that downwards, and 1.5% growth is not sufficient to deal with the trifecta of poverty and unemployment and low growth in South Africa. And we were hoping to break out towards the historical 3% growth rates that were maintained under the Mandela Mbeki period in South Africa. In Nigeria, I would just say they have been undertaking some very positive structural reforms around the currency, around the oil markets and so on, and they have built the refinery through the Dangote refinery initiative.
Yeah.
And I think they may well benefit significantly through this.
Yeah, in fact, Bloomberg reported earlier today that Dangote's businesses are seeing a material uptick right now in interest, given what's been going on. I do want to go back to South Africa and the importance, or I guess in the past, the importance of that economy to sub-Saharan Africa. How intertwined are the economies down there right now, or have they all pretty much diverged on their own in terms of policies and obviously in terms of just growth?
No, there's a very strong correlation.
Yeah.
Still, the amount of inter-African trade is not where it should be. You should have a far greater dependency of inter-African trade, but it is significant. So that is a transmission belt for exports, imports, and trade in Africa. South Africa is still the dominant economy in Africa. Nigeria is sort of catching up and may well catch up through this crisis, depending on how long it is. I would say, to your former guest, one of the most outstanding features of South Africa and understanding South African markets is its very deep liquid capital markets. In fact, South Africa is one of the only blocks in the EMEA where you have large equity participation in the emerging market indexes. And the GDP to market capitalization ratio is the greatest in South Africa of all economies anywhere in the world. So the South African capital market is about 1.2 trillion and the GDP is about 400 billion. So it's 3 times GDP, which is a demonstration of how liquid the capital markets are.
Yeah.
And the funds love to trade South African currency, bonds, and equity markets as a proxy for emerging markets as a whole. So South Africa's financial markets are a great asset that is outstanding at this point.
Yeah, and the liquidity issue, definitely one we kind of forget sometimes as to why it keeps things so powerful. Colin, we have to leave it there. Really appreciate it. Colin Coleman is the former CEO of Goldman Sachs' Sub-Saharan Africa banking business. Though some breaking news, Katie Greifeld, crossing the wire.
Yeah, this coming from Super Micro, of course, a company we've been following very closely today. The company announcing that board member Wally Leal has resigned. Remember, this was a stock that had plunged 33% on Friday off of news that 3 people associated with the company had been indicted. You can see some action being taken now, and shares rising a little bit post-market, higher by about 2.4%, but again, a 33% wipeout in this stock today. This is The Close on Bloomberg. Early stage valuations are on a record run, rising to a new high in Q4, according to recent data. Now, it sets up for a promising 2026, though we do see some concerns percolating around liquidity and around software. Our next guest's firm was founded by Melinda Gates to accelerate social progress by investing in overlooked and early stage fund managers and companies. Joining us live, I'm pleased to say, is Erin Harkless Moore. She is Managing Director of Investment over at Pivotal Ventures. Erin, great to have you with us. Let's talk a little bit about the VC landscape, because you think about what we've seen unfold over the past several weeks, the past month or so, a lot of concerns about software, about AI, and now you add, a war on top of it. How is that impacting the space in which you operate?
Katie, thanks for having me. It's good to be with you today. It's a time of uncertainty, as you've said, in the markets, concerns about inflation, the SaaS apocalypse, and that's hit software stocks, but and early stage companies as well. But we remain focused on our mission at Pivotal, which is to advance social progress and specifically women's power and influence. And we're excited to back a set of fund managers and early stage founders that are innovating in some of the most important sectors in our economy. Leveraging AI to do it, of course, but things like financial access and women's health and the care economy, where we see huge opportunities for innovation and opportunity.
Well, let's talk a little bit about the care economy. I find it a fascinating space. When you think about caregivers, I mean, certainly an underappreciated part of society, but how do you invest around that? What sort of opportunities are you finding there?
Sure. The care economy is a $648 billion market, Katie. That's bigger than the pharmaceutical industry. We're all caregivers at some point in our lives, and we need a more modern system, better technology to support caregivers. So we're investing directly into companies that are innovating in this space at the early stage, that are pioneering in areas around the child welfare system, as an example, an amazing company called Benti. It's a software solution for the child welfare providers that's saving them time, improving outcomes, and making lives better for kids. So that's the kind of support that caregivers need, the systems that need to be modernized to really meet the needs of caregivers where they are today.
Erin, I am curious about some of the longer-term changes that we're seeing in society. And we've had a lot of wealth managers on this program that have talked a lot about just the importance of kind of a broadening base of women clients, the idea that their wealth and their situations in terms of their family situations are evolving in a way that makes them potentially probably one of the more dominant consumers in that space. And I know that your fund has been a big investor in Ellevest. I am curious as to whether you see those trends in place right now and how far you think that goes with regards to the differences in growth in gender when it comes to demand for financial services.
Romaine, women are going to control a greater share of wealth in this country over time as assets are passed to them, next generation. And so we need solutions that meet women investors, that meet women asset owners where they are, and that are designed for their needs and what they're looking for in the market. So we see that as a big opportunity to invest around. And oftentimes, and this is why we're big believers in building a portfolio that has diverse perspectives at the table. Oftentimes, those that are closest to the problems can come up with the solutions to solve for them. And so we want to support and invest behind a set of founders that are innovating in areas like wealth management, like access to capital, tools that support small business owners. It's a big gap. I saw a stat recently that if we achieve gender parity in entrepreneurship, so got more capital to more women founders and small business owners, that would add over $5 trillion to the global economy. Yeah. So we're trying to find solutions that will do just that across the spectrum of financial markets.
Staying on those structural themes, and specifically when it comes to new business creation, I am curious, are you seeing more new business creation? I don't mean just amongst women, but overall. And there's been a lot of discussion here about how, at least here in the United States, the regulatory environment and other sort of impediments have actually slowed growth in that space.
We haven't seen it in our portfolio. We are constantly finding great founders that are building exciting businesses. The challenge, though, is the access to capital, and particularly for women, that remains an issue. Last year, PitchBook data showed that almost $74 billion went to teams with at least companies with at least one female founder, which is great. But only 1%, about 1.2%, went to female-only founder teams. So we still have work to do. That's a big gap, and we want to find ways to get those entrepreneurs that have the ideas, the capital that they need to innovate and grow their businesses.
Well, I see that Pivotal has backed 27 firms and 13 companies to date. When you take a look at your portfolio right now, how are you feeling? I mean, does that feel like the right size, or do you have some dry powder here?
We have dry powder, Katie. We're still deploying capital. We typically invest in a handful of fund managers every year. I'm really excited about the opportunity to back what we call next generation fund managers. That doesn't mean that these individuals are new to investing. Oftentimes, they have very lengthy track records at some of the best institutions and firms around the globe, but they're building new firms that are finding in solutions and innovations and backing founders across the capital stack in all segments of the economy. So we see tremendous opportunity there to support some of these fund managers as they're building their businesses and their firms from the ground up, and being an early catalytic partner to them with our commitments. The same is true on the fund manager side as well, on the founder side as well as it is on the fund manager side. Yeah. We're not lacking for opportunities or ideas to invest behind in those themes like women's health and care economy in our portfolio.
Erin, Really appreciate it. Erin Harkless Moore, Managing Director of Investment over at Pivotal Ventures. All right, we want to make a hard pivot from that and go back to that breaking news that we had on Supermicro just a little while ago, learning that Wally Leal, a board member of Supermicro, has now resigned. This is on what we learned earlier in the day here, that U.S. prosecutors had indicted him for allegedly sending U.S. assembled servers containing NVIDIA's cutting-edge chips to China in violation of U.S. export controls. Supermicro shares were down at 30% in the cash session. You see them up about 2%, but a lot of questions right now just about the reputational risk for this company, a company that has actually been in this position before. Mandeep Singh joins us right now, Global Head of Tech Research over at Bloomberg Intelligence. And Mandeep, it seemed like a couple years ago there was some reports here raising questions about this company's accounting. It seemed like we had gotten through that. And now, of course, we have these new charges coming out of the U.S. and at least one of the figures in this resigning from the board.
Yeah, I mean, it's huge, and it kind of ties in with the audit and governance issues that the companies has had in the past. And look, I mean, the good thing for Supermicro is it's in a market that is growing. I mean, Jensen Huang just gave a $1 trillion sales forecast through 2027. So from that perspective, you know, a Dell can do well in this market, a Supermicro can do well, and they had a really good quarter. But I think when you look at the pipeline, you have to ask yourself, who are the customers that Supermicro will have going forward, given the type of issues that it's dealing with right now? And that's where I think XAI is a big customer, but none of the other hyperscalers, I think, right now is a customer of Supermicro.
Well, it's an interesting point, Mandeep. I mean, you mentioned that this company had a pretty good quarter. It has some, real-time customers here. But what is the reputational risk of being associated with a company like Supermicro? As Romain laid out here, they've been in this situation before. This isn't a first-time offense necessarily.
Yeah, and the two metrics for me are backlog and gross margin. So when you compare backlog of Supermicro, it's around $13 billion. Compare that to, Dell, which has got a $50 billion backlog for their AI servers. Gross margin for Supermicro have gone from 15% to 6.4% over a span of few quarters. So that just goes to show that they have to take a hit on pricing to even have that business from XAI. And, right now their visibility is quite low when it comes to the backlog number that I alluded to. But overall, I think execution is going to be difficult given the person in question here who has been indicted is one of the co-founders. And it's a pretty big amount and a very sensitive issue when you think of the geopolitical context.
All right, Mandeep, really appreciate the context. That is Mandeep Singh of Bloomberg Intelligence talking about Supermicro computer shares bouncing a little bit after hours right now, but certainly not erasing that 33% drop today, Romain.
Yeah, and we should be clear as well that Supermicro itself is not actually been named as a defendant in it. It is just the three individuals, and the company has said that it is cooperating with U.S. authorities. Katie, it's been quite a week.
I know, and there's a new one coming up just in days.
All right, well, let's set you up to what to watch for the next week here. CERAWeek actually kicks off, and of course, this is the big energy conference that takes place every year down in Houston. I guess it's taking on a different complexion now, given the backdrop of the war in Iran.
Absolutely. Looking forward to conversations out of there. We also have the China Development Forum and the Milken Global Investor Symposium in Hong Kong kicking off on Monday, and then Tuesday, Anthropic heads to court.
Anthropic heads to court. We're going to get some earnings next week as well. Probably Chewy and Jefferies, probably more of the notables if you care about meme stocks. GameStop is also going to be in the mix as well. We're also going to hear from ECB President Kristin Lagarde midweek on Wednesday. But let's turn to Thursday. The G7 foreign ministers.
Meeting in Paris.
Yeah, I think they have a lot to talk about.
Absolutely. Again, it's going to be interesting to see what sort of readouts we get from that. We also have former Venezuelan leaders Nicolas Maduro returning to court. You think about how this year kicked off.
The news cycle has been so relentless. I kind of forgot about him.
I know. That was just a couple months ago.
You missed consumer confidence and earnings out of BYD. We'll cover it all for you here, right here on The Close. For all your political coverage, stick around. Joe Mathieu and Kaylee Lyons coming up at the top of the hour, right here on Bloomberg.